I've been managing global equity income money for about 15 years, which I think is longer than most people in London. I established a global income fund at Newton in 2005, which over 10 years grew to over £5 billion in assets and was first in the sector over that period. I then moved to Troy in 2016 to establish their global income fund, which I manage and lead on, including the Securities Trust of Scotland, which is what we're talking about today. The objective is to produce income from global equities together with long-term capital growth. Well, at Troy, we try and produce above-average returns with below-average volatility. And we do that by concentrating on high-quality businesses and then allowing portfolios to compound over time. We think at this point that it's really important, particularly for people who have irreplaceable capital and are requiring of income, to concentrate on quality because we think valuations are pretty full. We think income is scarce. And actually, because of technological disruption, quite a lot of businesses are finding themselves very challenged. So we differentiate ourselves by being very long-term, by being quality-focused, and considering the downside as much as the upside in any investment that we make. Well, I've been managing money on this basis for about 15 years, so there are very few companies globally of quality and that generate an income that I don't know. But that's not enough to invest, of course. We have a universe of about 170 companies at Troy. That's not a static list. We can use it to build portfolios, but we also add to it and take away from it over time. In order to get a business into the universe, a note has to be written, it has to be debated by the team and signed off by the wider group, and then it may go into the universe. Once it's in the universe, I as the fund manager can decide when it goes into the portfolio and in what size. Now, in terms of holding period, we put an emphasis on the long term at Troy, and we try and have settled high quality portfolios. Because we're buying high quality business in the first place, we want to allow them to compound over time. So the ideal holding period is forever. But in reality, the turnover in the fund is about 10% per annum, and therefore our holding periods are about 10 years. Troy puts an emphasis on the downside in any investment that it makes and also tries to produce above average returns and below average volatility. That implies that we tend to perform better when markets are more difficult and we can underperform when markets are particularly strong. But we should also mention today there is this risk of inflation. And how do we perform when there is an inflationary backdrop? Investors are not unreasonably worried about inflation currently. Now, our view is we're keeping an open mind. We don't know if there's going to be inflation or not. We view the backdrop as very distorted by COVID, and we don't want to be making a big call on that either way. But what we do think is that interest rates are unlikely to go up because there's simply too much debt. So we're left with two scenarios. Either inflation dissipates, perhaps the economy slows down somewhat following this recovery from COVID, in which case I think we're pretty well positioned with the high quality portfolio that we have. Alternatively, inflation continues to rise, but rates stay very low. Well, in that sort of scenario, businesses that are able to raise prices would also be relatively well placed. Now, high quality businesses have particular attributes which allow them to have high returns on capital employed. And those same attributes allow them to have pricing power. And so we think in the latter scenario, we're also well placed.